Blockchain technology makes it possible to tokenize assets and raise money around the world at incredible scale, a perfect opportunity for the housing market, and many folks have tried, but it's tricky to nail down. Nevertheless, our next guest is launching a decentralized mortgage platform that provides a solution for lending. Please welcome Karl Jacobs, CEO and co-founder of Bacon Protocol and LoanSwap. So welcome, Karl. Bacon Protocol is minting 7 home mortgages as NFTs. Tell us how that works.
Yeah, we're actually up to 8 now. So basically the way it works is someone comes to us with the desire to get a loan, and we take out a lien on their property, just like we do normally, except this time we wrap an NFT around that lien and then loan against that lien, which is published on the blockchain.
So I guess the big picture question here is, why do we need home mortgages as NFTs? What is there? Is this addressing a specific challenge in the mortgage market? What exactly is the purpose?
Yeah, so basically the issue that we have is that mortgages are opaque to the blockchain today. And so what we chose was, let's figure out what the smallest piece of the real world asset, which is the lien on the home and is recorded at the county, is that we can bring into the blockchain, and then we can leverage all the power of the DeFi protocols in the blockchain in order to lend against that lien, which is very powerful and allows people around the world to lend money to people who want to have a house.
So, Karl, is this an actual first mortgage, or is it a second mortgage, a mechanics lien? Where are you in that whole structure? Are you the first mortgage there? And if so, do you have the right to foreclose? Does the owner of the NFT have the right to foreclose on the property should things go south?
Yeah, so the answer to your first question is all of the above. We can have first liens, second liens, and all that. This existing pool, this first pool, is called B Home, and B Home is originated to Fannie Mae standards, which would be the first lien on the home. The NFT holder, and there's a lot of laws around this, it does not have the right to foreclose on the loan. It's actually the group that's servicing the loan. And so they're highly regulated around the way and the process that they can actually do that. And it requires non-payment for a relatively long period of time and a whole bunch of legal and structural things that need to happen before that can occur.
So Bacon Protocol has launched B Home token, which you just mentioned, and you're planning to raise over $100 million worth of B Home token. So how does that work? And is there any concern that it's a security?
Yeah, I mean, obviously that's something that we think about a lot. So the interesting thing here is the guest previously was talking about how people are thinking about this as a security. So mortgages are not securities. They're regulated by the state on several levels. And each state has their different regulations for how mortgages are run. We're audited around a lot of the different rules and specifications that they have. And so a pool of them on the blockchain that is specified by the DAO, and then actually the Oracle is the one that figures out whether or not a loan is allowed into the protocol, and then it's voted on by the DAO. Is the approach that we've taken around the security issue.
So yeah, more to that point. I mean, you're buying the entire mortgage with this NFT, or are you buying tranches of it? Are you buying certain cash flows of it, or like exactly?
No, it's not that complex.
Purchasing?
It's yeah. So you're purchasing a coin. The coin is backed by a pool of mortgages.
Right. So the coin itself, it backs but you're expecting cash flow from that coin, correct?
Well, I mean, the way the coin works is basically it's a stable plus coin. So the coin is stable against the liens on the homes. So let's walk through it. So say you have a $50,000 lien on a home, and then the coin is backed by a group of those liens. That's the stable part. The plus part is cash flow back from the borrowers into the protocol or the coin itself, and the coin price goes up.
So essentially you're expecting an appreciation in the value of the coin if let's say if it's a floating rate mortgage that you have here, you're expecting values.
Well, Fannie Mae's aren't floating; they're fixed.
Okay, and then you're basically you're assigning the cash flow based on the token, correct? And if there's a change in interest rate, the value of that changes. Ultimately, if there's a change in market rates, the value of the token itself changes alongside with it. I mean, how is it not a security?
Well, first of all, the market rates are determined by the people investing into the
Correct.
pool. And then as far as like the kind of what you're headed toward is a bunch of the tests that they use for securities. So let's think about the kind of two ways you unwind this, right? It's basically the first is that is it regulated by another group? This group of securities, that people talk about. Generally, they're regulated by the federal government or they're not regulated by anybody. Mortgages are regulated by another entity. They're regulated by the states and very actively. And so there's that piece. And then the other piece is, how is the money generated? Well, is the money generated by us doing something or by the people who've actually invested into the asset class? And in this case, it's the people who've invested in the asset class. We're not really doing anything. And mortgage is a marketplace by itself. And so even today, we don't specify what mortgages get done. We take what our investors are interested in purchasing, and we take those specifications and we present those to customers, and customers can choose those mortgages.